Okay. Okay, guys. Good evening. Welcome to the second TRG for MA. I'm looking at the names. Some of them are familiar, some of them aren't. Okay. So, yeah. Yes, right. So, before we start, right, let me just give you a quick recap of what we did in the previous TRG. So, anyway, throughout this series, what we're going to do is simply do a set of 100 MCQs. Okay, MCQs as well as MTQs. We will be doing a set of 100 of them. And I have picked the 100 in such a way that all areas of the syllabus, or at least the majority of the important areas of the syllabus, they are going to be covered. So I'm talking about 90% syllabus coverage. Okay. So by the time we finish off this TRG, if you're able to do all the questions that we did, right? So if you're comfortable with all the questions that we have done in this TRG, then my advice to you is don't waste time beyond that point. Okay. All you have to do from this point will be, after the TRG is all over, sit for about 2 mock papers. Okay. Time yourself, see what your marks are. Always now, if you get say 70 for a mock paper, chances are that the actual paper you will get about 10 marks more. Okay, I know some people think, okay, how is that possible, right? The reason is when you are in your actual exam setting, you tend to focus a little more. Okay, you tend to focus a little more. You don't make careless mistakes. Okay, and you make sure before you go for the paper itself, you will make sure that you're very thorough with all areas. Okay, whereas a mock paper, of course, you're doing it at home and you know that even if you know the marks are not so good, it's fine. It's just a mock exam. Okay, so understand that definitely your actual paper, your marks will be around 10 more than the mock exam, unless you're a person who properly focuses and does every mock exam that you do. Okay, so once you're done with these 2 mock papers, there's just one last thing you have to do, and that is go ahead and book the date of your exam. Okay, I can't stress this more. In my so many years of teaching MA, I have seen this problem come again and again, where people spend years just procrastinating. Okay, they just try to put the date, they just delay it and delay it and delay it. And before they know it, 2 to 3 years have passed by, because some of them are working, some of them have other educational qualifications they're following. Okay, so there is a very good chance that if after you have got your 100%, once you've done everything to do with this paper, if you don't book the date soon, chances are that you will start forgetting. Okay, we are all humans. We will start forgetting. At that point, what will happen? You will start delaying because you'll be like, no, I have to learn that again. I have to learn that again. And then with time, what happens? So many years have passed by. Okay, so when it comes to these on-demand papers, in my opinion, that is the biggest disadvantage. The fact that we don't have a fixed exam date. Okay, that causes a lot of people to waste time. So what I'm trying to say is, this is MA, end of the day. Okay, I don't want to say it, but it is the truth. The marks don't really carry forward anywhere. Okay, like for example, if you do skills level from the performance management paper onwards, if you the more marks you get, the better your degree will turn out to be. The class of your degree, it will actually be a little higher. But when it comes to these on-demand papers, even those marks, they don't really count even for the degree. Okay, so there is no real reason for you to delay this exam. Okay, I'm not saying go sit and aim for 51 marks. That's not what I'm saying. But what I'm saying is there's no reason to panic. There's no reason to just get stressed for no reason. Okay, so that is what I want to start this TRG with. All right. Okay, so we finished off question number 11, okay, which was a good revision for the high-low method. Now we are going to look at a completely different area of the syllabus where we focus on internal rate of return. Okay, so before I do this question, let me just give you a recap of what this area talks about. Okay, so this comes in a chapter called capital budgeting. Okay, so what is capital budgeting? Basically, the normal budgeting that we do, that is the raw material budget, the labor budget, you name it, it's all to do with a short-term plan. Okay, it's all to do with a short-term plan. Whereas if you are a business, you might have certain decisions that you will have to take which doesn't just affect the short term. Okay, so maybe it will affect the next 5 years or the next 10 years. So the moment you have to take such decisions where the next 5, 10 years, basically any number of years, more than 12 months is going to get affected, you call that capital budgeting. Okay, and there are certain techniques that we have to learn under capital budgeting. So the most important area of capital budgeting and the only area that we will look into is something called investment appraisal. Okay, so what is this investment appraisal? It's a very simple theory. Which projects, now there will be many new projects. As a business, you will have many new projects that you can invest in. Okay, like for example, there might be a new product that you can invest in. There can be a new machine that you can invest in. Okay, likewise, there will be different opportunities that you have. But you as a business, unfortunately, you will not have unlimited cash. Okay, unlimited projects, yeah, may be available, but unlimited cash, most of us are not in that situation. Okay, so in that case, what do? We have to understand, okay, with the amount that we have, with the amount of money that we have, which projects should we invest in? So if there are 100 different options, which ones should we invest in? So obviously the decision should be based on profitability. Whichever projects gives you the highest return, you should go and invest in that project, right? So how do we decide which projects give you the high return? We use certain techniques. Okay, so the first and most important one that we look at is something called net present value. Okay, or you might be more familiar with this NPV. Okay, so NPV, we try to measure after the investment is over. Okay, so since this question came up, actually you might be having this question because we used to use different terms with financial accounting, right? So I'll come to that, right? Anyway, so we have to look at NPV, then we will have to look at internal rate of return, and then we look at payback. Okay, so let me take you to that particular slide so it will make things easier for you as well. Okay, right. So I think Zainab asked this question. What was the question? She's asked if an asset expenditure budgeting, is it the same as capital budgeting? Okay, right. So the thing is this, Zainab, right? We used to have two names. One we used to call capital expense, where we say, okay, this is an expense where we probably buy a non-current asset, or we alter, we make a significant improvement to a non-current asset in such a way that now its earning capacity has increased. Okay, so the best example of that is, let's say we had a machine that we bought. Buying it is definitely capital expenditure. And let's say we did something to improve its capacity. Let's say, the capacity was 1,000 units per hour. We did something and made it 1,200. Maybe we changed the motor or something, it became higher. Now, in that case, the price of the motor, how much ever you paid that increment, that will also be considered capital expense. Now, this word capital expense only, we substitute it, we change it, and we call it an asset item. The reason why we give the term asset and we don't call it capital anymore is, there is no logical reason behind it, right? Because accounting wise, one of the things that we do is when we have nothing else to do, we change names. Okay, for example, we used to call something the income statement, then suddenly we changed it to statement of profit or loss. Okay, then after that we thought, no, this is too short. Statement of profit or loss and other comprehensive income. Okay, likewise, we just keep changing names. So likewise, here also we used to call it a capital expense, but now we are calling it an asset expense. The reason why we do that is when you buy a non-current asset, or when you do any significant improvement to a non-current asset, we don't put that expense in the income statement. We record it as a non-current asset in the statement of financial position, in the balance sheet. And every year we release a small portion in the form of depreciation to the income statement. So because we are putting it in the balance sheet as a non-current asset, that is why we call it an asset item. Okay, so if it is an asset item, then yes, you're right. We're talking about capital budgeting. It used to be a lot simpler, right? Because then we used to call it a capital expense, capital budgeting, same capital. The word capital is there. But now since we have changed the terms a little, you might have this question. Okay. Then we have the second type of expense, which is an expense item. The reason why we just call it an expense item is because when we incur that particular cost, we immediately record it in the income statement and not in the balance sheet. Okay, so it could be anything other than the purchase of that machine and any significant improvement. So anything other than that, that will be considered as an expense in the income statement, and that we are not talking about in capital budgeting. Okay, so I hope that answered your question. Right, so let me go to the different techniques. Okay, so the first thing that we look at is payback, right? So payback is actually easily understood by everybody. Okay, because anybody, if you, now for example, if I'm going to take money from you, okay, say I'm going to take a loan from you, $100,000. Okay, now the first problem that anybody has with regard to lending money is the fact that until I give you back that $100,000, you are at risk. You are at risk, right? Because what if I don't pay you? What if I go bankrupt? What if something happens and you don't get your money, right? So the problem is the longer it takes for me to repay, if I repay you in 1 or 2 years, then it's good because you only have to wait for 2 years. But if I take this money for say 25 years, then the risk is higher for you because there is a higher chance of default, a higher chance of me not paying you back that amount, right? So one of the first techniques that we use in investment appraisal is payback, where we measure how long will it take for me to earn back my initial investment. Okay, so if I invested 1 million today, in how many years can I earn it back? If it says, okay, I can earn it back in 5 years, then I will have a target rate. If I'm happy with that, I will accept. Okay, but let's say for one particular project, I calculated payback, it was 200 years. Okay, now the moment I see the 200 years itself, I know this project is not going to be good for me because in 200 years, I am not going to be alive. The person who took the money from me is not going to be alive. There is absolutely no point in investing in that particular project. Okay, so the first method that we look at is payback, and this is how we usually calculate payback, right? We have a structure like this. We have the years, we have the cash flow, as well as the cumulative cash flow. So using the cumulative cash flow column, you will have to figure out what is the payback period. Then we look at NPV. Okay, and NPV, you have to understand, is the best technique that we have. So we have payback, we have NPV, we have IRR, but of the three, the best and superior technique is NPV. So with regard to NPV, usually we have this format. We have the cash flows, the discount factors, and then the present value, and then we take a total. Okay, so we will do questions where we calculate NPV. I'm just giving you, the basics before we start. And with regard to NPV, there is an important decision rule. If the NPV is positive, we will accept the project. If it's negative, we will reject the project. And if it is zero, if the NPV you calculated and it is zero, it means you are breaking even. Okay, you're not making a profit, you're not making a loss. Okay. And finally, we have to look at IRR, which is the internal rate of return. Okay. So what is this IRR trying to measure? It's trying to measure the discount rate at which NPV is zero. Okay, so that's what that is exactly what it's trying to measure. And the decision rule is if IRR is greater than the cost of capital. So cost of capital, the business from business to business, it will change. So we compare the IRR that we calculated with the cost of capital for that particular business. And if it is greater, if the IRR is greater than the cost of capital, we will accept the project. All right. So how do we calculate IRR? We use this equation. Okay, this equation, unfortunately, is not given to you at your exam. You will have to learn it. All right. So if you're not familiar with it, this L is the lower rate of interest. So the thing is, when you're calculating IRR, you have to have two NPVs and two discount rates. Discount rate means interest rate. So here this equation, what it's saying is the lower rate of interest. To that you have to add the NPV at the lower rate divided by the NPV at the lower rate minus NPV at the higher rate multiplied by the higher rate minus the lower rate. Okay. Right. So in that question that we had, which was the 12th question, we have to use exactly this equation to figure out the answer. Okay. So let's go ahead and do that now. Okay. So let me give you the equation in case you don't know, and you can have a go at it, right? So this is the equation. Okay, this is the equation. You can see if you can figure out the IR. I'll give you about 5 minutes. See if you can do it, right? So I'll tell you the common mistake that students usually make. They don't put the values in the calculator properly. That's the only problem. If there is a problem, that will arise when it comes to IRR. Okay, see if you can get the figure and drop your answers in the chat. Okay, we have a 12.1, which is C. Right. So let me do this as well. Not complicated at all. Right. So the lower rate is, we have a discount rate of 10%. And at that rate, the NPV is 2,700 positive. And we have a discount rate of 15%. And at that rate, the NPV is 3,740 negative. Okay. So using the above figures, what is the best approximation of the IRR of the investment project, right? So we have IRR should equal to the lower rate, which is 10 plus open brackets, the NPV at the lower rate, which was 2,700 divided by the NPV at the lower rate, which is again 2,700 minus the NPV at the higher rate. Okay, so at 15%, the NPV was 3,740 negative, right? So this 2,700 minus is from the equation itself. NPV has a separate minus sign, so you have to include that as well, minus 3,740. Okay, into the high minus the low. So the high interest rate was 15, minus the low was 10%. Okay, so you need to put this in your calculator. So let me show you how it will look like, right? So exactly, now I know in this particular, what I've typed, it's not proper, right? Because it's not in a fraction form. But when it comes to your cal, you can put it as a fraction itself. Okay, so let me show you how you put it in. So we know the lower rate is 10 plus, open a bracket, open the fraction sign, NPV at the lower rate, which is 2,700, divided by NPV again at the lower rate, which is 2,700, minus, now this minus is from the equation. Okay, it's not the NPV's negative sign. So we know that at the higher rate, NPV is 3,740 negative. So we have to open another bracket and put it as minus 3,740. Close that bracket. And then go to the right and multiply it by the higher rate, which is 15, minus the lower rate, which is 10. And close the bracket. Okay, so that should give you your IRR as 12.09. So you can round it up and make it 12.1%. Okay. One tip is when you're putting the IRR, I mean, when you're putting the numbers into the equation in your cal, for IRR, ignore any percentage signs, right? So don't put it like this. For example, I know that this is 15% minus 10%. No, so don't put it like this, right? 15% minus 10%, because then your answer will come to so many decimal places. Okay, that will make it difficult for you to figure it out. So ignore percentage signs when you're putting it into the IRR equation. Okay. Right. So that answer will be C. Right. Good. Okay, let's look at the 13th one. It's saying CY company has decided to lease a machine. 6 annual payments of 8,000 will be made with the first payment on receipt of the machine. Below is an extract from an annuity table. They're asking you what is the present value of the lease payments at an interest rate of 10%. Okay, so basically 6 annual payments of 8,000 should ring a bell. Okay, meaning it has to signal something to you. If you have 6 annual payments for a fixed amount, we have a special name that we give it. We call it an annuity. So they're asking you for the present value of an annuity. Okay, so have a go at this. See if you can get the present value of the lease payments. They have even given you the annuity factor, so you don't have to look at the tables. Okay. $34,840. Not correct answer. 38,328 is correct answer. Okay, so Asya, see what do you think went wrong? So whenever you have present value, take my advice, it's always a good idea to draw a number line. It will definitely help you. Okay. So let me just draw this situation that we have here. Okay. So you can see what's happening here. We are going to lease a machine. Okay. And we have to pay 6 annual payments of 8,000. And the first payment, it will be made with the on the receipt of the machine. That means, obviously, I will get the machine today itself. No, if I lease a machine, I'm not going to get it 2 years later. I will get the machine immediately. So in year naught, which is today, there is something that's happening. I am actually paying 8,000 installment. Okay, so 8,000, I start the payment in year naught itself. Okay, then what happens? Okay, year naught is there. Then we have year 1, year 2, year 3, year 4, and year 5. Okay, so now anyway, totally I should have 6 payments because installment is 6 annual payments of 8,000, right? So let me just put 8,000 6 times. So 8,000 once, then again 8,000. So we have 1, 2, 3, 4, 5, and one more 8,000. Okay, so that's the total lease installments that you will be paying. So year naught you pay 1, then the following year 2, year 3, year 4, and year 5. Okay, so you have to notice something, right? Now, although we pay 6 annual payments, we are not paying it for until year 6. Okay, our last payment is actually happening in year 5 itself. All right, fine. So now what happens? You can see there is a small difference in this annuity compared to the normal annuities that we do. Okay, what is the difference? Usually the normal annuities that we do, in year naught, there won't be any payment. The first payment will start from year 1 only. So for example, this 8,000, it will start from year 1, year 2, year 3, year 4, year 5, and it will go all the way until year 6. That's how usually it is. But in this case, what has happened? There is an additional 8,000 that you can see in year naught. But remember, this 8,000, since the payment is happening in year naught, this is already a present value. That's already a present value. So you don't have to discount that again. Okay, because that's already in today's terms only. So what we have to discount actually is these 8,000. So that's 1, 2, 3, 4, 5 payments of 8,000. You have to discount it. Okay, so this is very clearly an annuity. So if you multiply it with the annuity factor for 5 years and they're telling you 10%, you should be able to get the present value of this annuity. Okay, so let's do that. Present value of annuity. Okay, so we know we have 8,000 and the annuity factor. Okay, so present value of annuity is usually annuity into the annuity factor. Okay, so here we know that the annuity is 8,000 and the annuity factor, we have to look at 10% for 5 years. Okay, so always remember, you have to look for the number of payments that we make. So you can see 1, 2, 3, 4, 5. So that is why we are looking at the 5-year payment. So that will be 3.791. Okay, so 8,000 into 3.791, that will give you 30,328. Okay, now it doesn't end there, right? Because these 5 payments of 8,000, the present value of all of them together is only 30,328. But in addition to that, there was another 8,000 that we pay in year naught, right? So we can't forget that. So to this figure, you will have to add another 8,000. Okay, so then you get 38,328. Okay, so let me just show this as well. All of these 8,000s, when you bring it back to year naught, it becomes 30,000. 30,328. Okay, so in addition to the 30,328, there was an 8,000 as well, which was already in the present value. So we have to add them both together. So we get 38,328. Okay, so that's how you get the present value. Okay, so those of you who have to take it down, take it down. The rest, you can have a look at 19.414 and see if you can figure out what the answer is. Okay, so take this down, and once you figure out what the answer is for the 14th question, drop your answers in the chat. We'll discuss. Okay, see. Right, let me see. Okay. Says, which of the following would be best described as a short-term tactical plan? Okay. So when it comes to planning, there are three different types of plan. We have a strategic plan. Okay, strategic, there is tactical, and there is operation. Okay, so strategic means usually it is decisions taken at the topmost level. Okay, so senior managers, the CEO, CFOs, the decisions that they take, most of the time it will be a long-term plan. Okay, so it won't be just a 1-year plan or a 6 months plan. It will usually have a time span of 5 years or more. Okay, so that is a strategic plan. Tactical is the type of plan that middle managers have to undertake. So usually they will have a period of about 1 year, around 1 year. And you will have line managers and people who are in the middle of the organization who will take those decisions. Operational, they are taken by the junior managers. And when it comes to operational plans, we're talking the time that we're talking about is almost like a day-to-day plan. Okay, so keeping that in mind, let's let's go through all of the points, right? So the first one is saying reviewing cost variances and investigating as appropriate. Okay. So when I look at this renewing cost variances, to me it's striking like something between strategic and tactical. Okay. So I can't really pinpoint and say what it is. So let me just go ahead and read some more, right? Comparing actual market share to budget. So the moment we talk about market share and stuff, it's very clear that is a strategic plan. Okay. Lowering the selling price by 15%. Okay, now honestly, when I see that, It feels very tactical to me, right? Because a CEO will not be concerned about discounts and things like that. After you do the discount, after you get the profits, once you show him the statement, he will analyze and see if everything you did is correct. But in the first place, he won't really come into figuring out, okay, should we give a discount? Should we not? Usually CEOs don't get into that kind of decision making. So C kind of really fits into tactical. Monitoring actual sales to the budget. Okay, now here also, we can't, like properly pinpoint, right? So like I said, C seems to be very obvious. That is the example of a short-term tactical plan. Okay, so likewise now, there are a lot of theory-based questions where you will have to choose the most appropriate answer. Like there will be 2 or 3 that make sense, right? But you should be able to pick the one that you feel is 100% sure should to be that particular question's answer. Okay, it's not easy. It's not easy. I know it's not easy. But with time, once you start doing a lot of questions, this will start making more and more sense to you. You'll start getting the hang of choosing the correct answer. Okay. Right. So 19.15. A company made 17,500 units at a total cost of $16 each. 3/4 of the costs were variable and 1/4 was fixed. 15,000 units were sold at $25 each. There were no opening inventories. By how much will the profit calculated using absorption costing principles differ from the profit if marginal costing principles had been used? Okay, so we did this question even in the last TRG. I told you, if you have come for my classes also, I have told you this again and again. This is a very, very common question. They always like to test it. Okay, the difference in profits because of absorption costing and marginal costing. Okay, but this question is a little different. Meaning the way they have put the question forward is a little different to what it usually looks like. Okay, but still the concept is the same. See if you can figure out what the answer should be. Let me know once you have answers. Okay. Give the others some time as well. Anybody else? I just got one answer. Something we've been doing quite a lot. Okay, let me help you out. Okay, right. So they're asking you, what's the difference going to be between absorption costing profit and marginal costing profit? So for that, we have an equation. This most of you will be familiar with. We know that the difference is going to be equal to the change in inventory multiplied by the OAR, overhead absorption rate. Okay, the change in inventory multiplied by the OAR. Now here in this question, change in inventory, it seems to be perfectly there, right? We know that we made 17,500, that's the production. We sold 15,000. So change in inventory is basically the difference between the two. So let me type that here, change in inventory. That is 17,500 minus 15,000. So we're talking about 2,500. Now OAR, there is a problem, okay? Usually, how do we calculate OAR? It's your total fixed overheads divided by, maybe it can be the budgeted units or the labor hours or something. Now here, the only information that they are giving me is the total cost to make one unit is going to be $16. Okay, $16 to make one unit, and they're saying 3/4 of this cost is variable and 1/4 is fixed. Okay, so the only thing I know with regard to fixed cost is it's going to be 1/4 of this $16. Okay, so we have my $16 multiplied by a quarter. Okay, so we know that the fixed cost portion, we're talking about $4 per unit. Now, this is the closest that we have to OAR because we don't have the fixed overheads total figure, and we don't even have the number of units that, or the machine hours or the labor hours or anything to do with OAR, we don't really have. The only thing that we have is this cost data. So we have to make do with what we have. Okay. So then we take the difference. Change in inventory is 2,500 into OAR 4. Okay, so we're talking about 10,000. But it doesn't end there. We have to figure out, okay, is absorption going to be 10,000 more or is it going to be 10,000 less? Okay, so for that we have to see, did inventory increase or decrease? Okay, so if you look here, we have produced 17,500. So the production is, is 17,500 and sales is 15,000. So the production is greater than the sales. That means our inventory has increased. Okay, because we have made more and sold less. So inventory has increased. When inventory increases, absorption costing gives the higher profit. So in this case, it should give 10,000 more. Absorption costing profit should be 10,000 more than the marginal costing profit. So here it's saying it will be 10,000 less. That's wrong. Absorption costing would be 10,000 greater. That is correct. Okay, so 30 and 40 is completely out. Right. So answer there is B. Just a small tip, it doesn't work all the time. But when you're doing MCQs, if you see 2 or 3 answers that have the same number, now here you can say 10,000, 10,000 is coming twice now. chances are that the answer will be among one of those two. Okay, now for example, let's say this was also 10,000. Then again, very high chance that the answer will be 10,000. It won't be the odd one out because odd one out is too easy, right? Most of the time, it will be the similar one. I'm not saying it's the case all the time. There can be one situation where it's not like that. But if there is a situation where you have to just guess, like you don't know what the answer is at all, you're just going to guess, then guess amongst the similar answers. Okay? Right. So you can take this down and you can try out question 16 after you take it down. Okay, so let me see. I do it by taking 16 divided by 3. Because they said that only the fixed cost was I'm sorry, they said that the quarter was the fixed cost. We only want the fixed cost component. It's the same, right? You can take 1 over 4 or take 16 divided by 4. As long as you can somehow divide the 16 into 4 pieces, that's fine. Okay, Arundhati. So we have C. Okay, that's a good sign. Right. Okay, so when it comes to EOQ, right? OAR is calculated using fixed. Yes, I understand what you're saying, right? We do use the fixed cost to calculate OAR. But usually what we use to calculate OAR, which is the fixed overhead cost, total cost, we don't have. Okay, so one of the ways we can calculate OAR is we take the total OAR and we divide it by the number of units that we produced. Okay, so we get the OAR per unit. So in this case, the only thing that we have is the fixed cost per unit. We don't have any machine hour data. We don't have any labor hour data. Okay, so the closest that we have is the OAR per unit, which we know is going to be a quarter of $16. So that's why we're using that figure. Okay, right. So it says here, a company uses the economic order quantity EOQ model to establish reorder quantities. The following information relates to the forthcoming period. So they're saying order costs are $25 per order. Holding costs is 10% of the purchase price, and purchase price is $4 per unit. Annual demand is 20,000 units. Purchase price is, hold on. No, sorry. 10% of purchase price, they're telling you the answer. 10% of the purchase price, which is 40, answer is 4. So holding cost is 4. Then they're giving you the purchase price separately, which is $40 per unit. EOQ is 500 units. No safety inventory are held. What are the total annual costs of inventory? That is the total purchase cost plus the total ordering cost plus the total holding cost. Okay. So this is a classic example of a question we can get under accounting for materials. Okay. So let me quickly take you there, because those formulas are important, right? Because none of these formulas will be given to you in your exam. You will have to learn it yourself, right? Okay. So look at this slide. Okay. Total costs relating to inventory. Okay. So suppose you want to buy inventory. Okay. For your particular factory, you want inventory, raw materials. There are 3 specific costs that you will have to incur. Okay, the first one is the purchase cost. Obviously, the amount that you have to pay your supplier. So if the purchase price is going to be, in this case, it was $40, and the annual demand, meaning how much we are going to buy for that particular year, let's say that was some number of units, then the purchase price into the demand will give you the purchase cost, how much we have to pay our supplier. Okay. Then we have the second, which is the ordering cost. So this is usually the transport cost and any admin costs. Okay, so usually transport charges and admin costs. How do we calculate that? It's the cost of ordering into the demand over the quantity that you order. Okay. Then the third cost that you will have to incur is the holding cost, and that is any cost that you have to pay because of the fact that you're keeping inventory in your warehouse. Okay, so for example, that can be the rent of your warehouse. You might have insured your inventory, so any insurance cost. You might have taken a loan to buy the inventory, so then any interest on that loan, finance cost will fall under holding cost. Okay, any security guard who is there at that particular warehouse, his salary, that also falls under holding cost. Okay, so how do we calculate this holding cost? Usually it's the cost of holding 1 unit for 1 year. How do we calculate that? Purchase price into a percentage multiplied by the quantity that you order divided by 2. Now, these 3 equations, guys, are very important, right? Because when it comes to accounting for material, okay, and most of the time they will somehow ask you something to do with accounting for material. It's a big chapter, right? So when it comes to accounting for material, whatever they tend to ask will revolve around these 3 equations. Okay, so make sure that you're very good with these 3 equations, right? So let me take all of them down. Okay, and let me take it to the Excel sheet, right? Was it on its purchase cost? Okay, let me type it itself. So we have purchase cost, which is P into D. Then we have the ordering cost, which is the cost of ordering into the demand divided by the quantity that you order. And then we have the holding cost. This is the cost of holding into the quantity that you ordered divided by 2. So they're asking you now calculate all of them. Okay. Right. So let's do it one by one. So what was the purchase price? That was 40 per unit. And the demand, annual demand is 20,000. Okay. Now it's a very common thing where they will give you monthly demand or daily demand or something. You should be able to convert it to annual demand easily. Okay. So 40 into 20,000, that will give you 800,000. Okay. So we have the purchase cost. Then we need the ordering cost. So the cost of ordering, we know it's 25 per order. So that you have to multiply. Okay, so 25 per order. That you have to multiply by the demand, which we know is 20,000, divided by the quantity that you order. So in this case, they're saying that we use the economic order quantity. So EOQ is the quantity that we will order, which is 500 units. Okay, so 25 into 20,000 divided by 500. So we have over here 1,000. The answer will be 1,000. Okay. And then finally, holding cost. They actually calculated it for us. They said it's $4 per unit. So it makes everything easy for us. We just take 4 multiplied by the quantity that we're ordering. Again, the EOQ, which is 500 divided by 2. Okay. So that should also give you 1,000. Okay. If you remember at the EOQ, the ordering cost and the holding cost, they equal each other because both those lines, you would have seen a graph before this, where when you draw the ordering cost and holding cost on a graph, you will notice that at the EOQ, at that quantity, those two lines will intersect. So that's why they are the same. So 8,000 plus 1,000 plus 1,000. So we have the total cost of inventory as 802,000. Okay. So the answer there will be C. Okay, so you can take this down and then you can try out the 17th one as well. They're asking you, so many things are there. They're just asking you which of the following values for A and B are correct in the formula y equals A plus BX. Okay. So the moment you see that, you should identify which area they're talking about. Okay. They're talking about, I'll help you out. They're talking about linear regression. Okay, so you should be able to use the formulas in that particular chapter and figure out the answers for A and B. Okay. So let me start this. We have an equation when it comes to linear regression. It's given to you at your exam. Okay. So we have this equation for B. We say that B equals to n times sigma x y minus sigma x sigma y, the whole thing divided by n times of sigma x squared minus sigma x, the whole thing squared. Okay, so there is an equation like this. You will be familiar with it. Even if you don't know it by heart, it's fine because it is given to you at your exam. Okay, right. So over here, they're telling me n equals 5. So I don't have to think too much. I'll open a bracket. 5 into sigma xy is 8,104 minus sigma x, which is 11, into sigma y, which is 400. Sorry, sigma h, which is 100, into sigma y, which is 400. Divided by, again, n times, which is 5 times sigma x squared, which is 2040, minus sigma x full square. So 100, the whole thing squared. Okay. Let me put the cal. Open a bracket. 5 into 8,104. Close the bracket. Minus, open the bracket again. Sorry. 100 into 400. Close that bracket. Over 5 into 2040. Again, close the bracket. Minus, open another bracket. 100. The whole thing squared. Okay, so that will give you B as 2.6. Okay, so we have the answer for B. B equals 2.6. So now all we have to do is calculate A, right? So calculating A also had another formula. Okay, so this is the formula for A, right? So A equals sigma y divided by n minus B times sigma x divided by n. Okay, right. So bring this down a bit. We have sigma y, which is how much? Sigma y, it's 400. Okay, so that's 400 divided by n, which is 5. Minus b, we calculated it as 2.6 into sigma x is 100 divided by, again, 5. Okay, so we can calculate a as well. So 400 over 5 minus 2.6 times 100 over 5. You can close your bracket. That will give you 28. Okay. So A is 28. So B 2.6, A is 28. Answer is B. Okay. Correct. So those of you who got this answer, yes. Right. So let me just zoom this out a bit in case you want to copy it down. Right. Okay, so since we started at 6, guys, let me give you a short break to pray in case you need to. So you can have a break, come back at 7:30, and we will continue. Okay, take this down if you haven't, and then you can pray, come back even 7:30, 7:35, and we'll continue. All right, so hope you guys are back. We can start off from the 18th question. Okay, so let me read just the requirement, right? Now, it's always a good practice when you see such a big paragraph to read the requirement or the last line first, because then you will understand what to look for in the question. So it's asking you, what is the relevant labor cost of the contract? Now it makes sense why it is so many, two paragraphs. Reason is when they're asking you for relevant cost, what they do, they tend to give you a lot of information that you don't need to use, right? So you have to pick the information that will be considered relevant in this particular contract. So with regard to relevant cost, we know that there are three words that we have to remember. Okay, so if something is relevant, it is a future incremental cash flow. Okay, so if you have a cost and you want to decide whether it is relevant or not, you have to check, does it satisfy these three conditions? If it satisfies it, then that particular cost is considered a relevant cost. Okay, so read through this. I'll give you about 2-3 minutes. See if you can figure out what's the relevant labor cost for this contract. And drop your answers in the chat, okay, once you're done. Okay, so let me read this, right? D you're saying, so 275,000, that's what you're saying. Okay, we'll see. Okay, right. GS company is considering accepting a 1-year contract, which will require 4 skilled employees. Okay, so it's a new contract. So when we're talking about relevant cost, we have to consider the cost we will incur as a direct result of this 1-year contract. So they're saying we need 4 skilled employees for this contract. The 4 skilled employees, they could be recruited on a 1-year contract at a cost of 40,000 per employee. So you can actually hire 4 new people, one option. The employees would be supervised by an existing manager who earns 60,000 per year. It is expected that supervision of the contract would take 10% of the manager's time. Okay. So if you talk about the 4 skilled employees and the 40,000 per employee, let's look if it satisfies the 3 conditions, right? Is it a future cost that you will incur? Yes, because only after you recruit these people, you will have to pay them 40,000. Is it incremental? Meaning, if you don't accept this contract, will you still hire 4 skilled employees? You wouldn't. Okay, because only for the contract you need these 4 people. So because of the contract only, you are actually hiring them. So yes, it is incremental. Is it a cash flow? Obviously, yes, we have to pay them cash. So we have this option of recruiting. Okay, so we are talking about how many employees? We're talking about 4 new employees. Each of them, we pay them 40,000. So into 4, we're talking about 160,000. That is definitely relevant. Okay. Then it's saying they will be supervised by an existing manager who earns 60,000 per year. Now, is that future? Yeah, you have to pay him 60,000 later. That's fine. But is it incremental? It actually isn't incremental, because whether you accept this contract or whether you reject the contract, this supervisor is already in your company. He's already doing some work and you're already paying him 60,000 per year. So this is an existing cost. This is not relevant. It's not incremental. So this 60,000, you can't consider it. Okay. Then they're saying, instead of recruiting the new employees, the company could retrain some of their existing employees who currently earn 30,000 per year. Okay, so this is one option, recruitment. There is another option where we can retrain. So in that, we are going to retrain our existing employees who are earning 30,000 per year. So if you look at this 30,000, is it future? Yes, but it is not incremental because they are already there. We already have to pay them whether we accept the contract or not. So 30,000, we can't consider it as relevant. Okay, but they're saying we have to train them, right? The training would cost 15,000 in total. Training will cost 15,000. Is that future? Yes. Is it incremental? Yes. Because only if we accept this project, will we go ahead and do this training. Okay. So the 15,000 training, that will be considered as relevant. This is relevant, 15,000. If these employees were used, they would need to be replaced at a total cost of 100,000. So what are they saying? If we take some of our existing employees, train them for this particular contract, we can't just stop there, right? Because those people were already doing some work now. So what do we have to do? We have to recruit some more people so that their old work is actually looked into, right? So that replacement, they're saying it will cost you 100,000. So think about it. Is that future? Yes. Is it incremental? Yes, because only if we retrain, we will have to incur this additional 100,000 cost because we need replacements. When will we retrain? We will retrain only if we accept the contract. Okay, so basically, if the contract is accepted, only then will you incur this 100,000 replacement cost. So definitely that is relevant. It's a cash flow. So yes, relevant, 100,000. Okay, so let's just take totals. If you recruit, you can have your total relevant cost will be 160,000. And if you retrain, your total relevant cost will be 115,000. Now this part is common sense, right? There are 2 options. You can recruit, you can retrain. Obviously, we will choose the option that is cheaper. Okay, so we won't go for the 160,000 option. That's more expensive for us. Instead, what will we do? We will retrain our existing employees and get a few replacements. So that will be 115,000. Okay, so answer will be A. Okay. If you haven't taken this down, you can take it down. Okay, so if you're done copying this, you can try the 19th one. They're asking for the correlation coefficient. So again, statistical analysis. If you remember, correlation coefficient is R. You don't have to memorize the equation. It's already given to you at your exam. In process costing, Arundhati, you have to learn just the normal loss, abnormal loss, that part, and the joint products and byproducts. Okay, I'm not sure when you took lectures. So if you took it like, about 6 months ago, then sometimes you might have learned something called equivalent costs, equivalent units. Okay, so that part you can completely skip. So equivalent units is basically where, they say material 60% of the cost was incurred in the previous month. Okay, and then closing inventory. Yeah, that part where they talk about percentages and stuff, that part is completely removed. So just the normal loss, abnormal loss, and the joint products and byproducts. Okay, no problem. Okay, so we have an answer for R. Let me just put the equation down here. So this is the equation. R equals to n times sigma xy minus sigma x sigma y, yeah, over the square root of n times sigma x squared minus sigma x, the whole thing squared. Okay, so close this bracket and then open another bracket. N times sigma y squared minus sigma y, the whole thing squared. Okay, so this equation, obviously you don't have to memorize it. It's given to you at your exam. So you have to put the figures in, that's about it. Okay, 0.17, which is correct. Okay. Right, so let me put in the numbers, right? Okay. So they're saying here, they're saying for a set of 6 data pairs for the variable X, which is profit, and Y sales, the following values have been found. So they're telling me it's 6 data sets now. So N equals 6. Okay. So 6 into sigma xy, that eliminates 14, minus sigma x, which is 2, into sigma y, which is 15. Okay. Right. So then what do we have to do? You have to divide this figure. So divide this by the root of, again, n, which is 6, into sigma x squared, they're telling me it's 30, minus sigma x, the whole thing squared. So we're talking about 2 squared. You can put a big bracket to, separate um, that particular area. Okay. Then again, open another bigger bracket and again another smaller one. Again, 6 into sigma y squared. So we're talking about 130. Close that bracket. Minus sigma y, the whole thing squared, which is 15 squared. Okay, then you can close everything. So this, you should be able to put it in your calculator to find R. Okay, so let me show you how to do that. We have a fraction to start off with. 6 into 14, close the bracket, minus 2 into 15. Close the bracket, come down, go for the square root first, okay? Then open two brackets because there are two here. 6 into 30, close this bracket, minus, open another bracket, 2, and you can actually put squared also there itself. And then close this bracket. And since we opened 2, close the first bracket that we opened as well, okay? Then again, put the multiplication sign, again 2 brackets, 6 into 130, close this bracket, minus 15 squared. So 15 squared, close the bracket and close the first bracket as well. So that should give you 0.17. Okay. So I'm not doing anything new, right? I'm just putting the numbers into the equation as it is. Okay, that's the best approach that we can take, especially in these areas, right? If not, it will take a long time for us to get the answer. Right, so this is R. Can take it down. Those of you who are done, you can try the 20th as well. Okay. Okay, 490 we have, okay. Others, do we have an answer? 40, okay. Okay, so I always say this. Some people think you can score with calculations, but calculations are the most trickiest when it comes to MCQs because even the wrong answer is part of your 4 choices. Now, for example, now Arundhati has calculated 490. She can see, okay, D is there 490. She won't think beyond that. She will just choose D and move on. Likewise, Asya will also just select 440 and go on. But obviously, only one of them is right or maybe both of them are wrong, right? That is the disadvantage when it comes to calculations. That is why I keep focusing on the fact that you have to focus on theory as well. Because it is true, if this paper was a written paper, okay, meaning there were no MCQs, you were actually writing it down or you were typing it, then there is a chance that you can pass with calculation. Okay, reason is we kind of weight more to, we lean more towards calculations than theory. Okay, but the problem is because it is MCQs, there is a chance that, a very good chance that you can get calculations wrong, even if you know how to do the calculation. Understood, right? So let's go through it again. It's saying Z company wants to calculate the total cost of a job. The estimated cost of the job is as follows. Okay, so they're saying we have direct materials, which is going to be 10 kilos, and each kilo we will have to pay $10. Direct labor 20 hours at $5 per hour. Variable production overheads are recovered at the rate of 2 per labor hour. It is as here. Okay, that's what I'm saying, because when you go for lectures, okay, when you go for lectures, your lecturer is actually teaching you step by step. So at that point, you will feel like the calculations are easy. Actually, it is easy. Like once you do a lot of questions, you will get the hang of it. But the thing is, when it comes in the MCQ, even a small calculation error, guys. Now, your examiner is not stupid. No, he won't just give random answers. Like he won't just give 50,000 or something. When he knows, obviously that answer can't be calculated. He will give you 4 options, and in that one will be correct. The other 3 will be commonly made mistakes. So if you somehow happen to make that mistake, you will end up getting one of those answers. That's the issue. Okay. Right. But do a lot of questions. That's what will help you, right? At one point, you will definitely get the hang of it, okay? Right, so variable production overheads are recovered at the rate of 2 per labor hour. Fixed production overheads for the company are budgeted to be 100,000 each year and are recovered on the basis of labor hours. There are 10,000 budgeted labor hours each year. Other costs in relation to selling, distribution, and administration are recovered at the rate of 50 per job. What is the total production cost of the job? Okay, so they're asking me for production cost. Yeah, actually, that's a keyword. Right, so we have direct materials. That was 10 kilos at $10 a kilo. So that will be 10 into 10, which is 100. Then you have direct labor, which is 20 hours into $5 per hour. So that is 20 into 5, which is again 100. Now here, usually when we are doing a cost card, we have direct materials, direct labor. If we had direct expenses also, we will add it here. And we give a special name here, right? We call this the prime cost. It's a good idea to always take that total. 100 plus 100 is 200. Then we have to look at the variable production overheads. Okay, so there they're saying it is recovered at a rate of 2 per labor hour. So we had 20 labor hours. We have to recover it at a rate of $2. So 20 into 2, that will be 40. Then they're saying fixed production overheads, again, production overheads for the company are budgeted to be 100,000 each year and are recovered on the basis of labor hours. There are 10,000 budgeted labor hours each year. Okay, so fixed production overheads, we have to calculate an OAR. Okay, so OAR, how do we do the calculation? We know that the budgeted fixed overhead was 100,000. We divide that by the labor hours, which is 10,000. Okay, so that is $10 per labor hour. That is the OAR. Okay. So we know that again there were 20 labor hours. So 20 hours into $10. So that is we're talking about 200. Okay. So 200 plus 40 plus 200, that will be 440. Okay. So this is actually the production cost. Now, after this, if you want, you can add the selling distribution admin 50 as well. But at that point, you are getting the total cost. Okay. So production cost is what they are asking for. So the answer is 440. You can't include the 50 because 50 is selling distribution and admin. Okay. Right. So those of you who haven't taken it down, you can. Okay. The others, you can have a look at these questions and see if you can get an answer. Okay. You can look at 20.1 and see if you can figure out the answer. Okay. Right. So hope you took that down. Let's have a look at 20.1. So it says here, a division of a service company is aware that its recent poor performance has been attributable to a low standard of efficiency amongst the workforce compared to rival firms. Okay, so they're saying we didn't do well. Okay, we didn't do well in that period. And when we analyze the situation, we can see that it's happening because our staff are not efficient. Okay, so compared to our competitors. So they're saying the company is adopting a balanced scorecard approach to setting performance targets. As part of its objective of closing the skills gap between itself and rival companies, the division's management has set a target of providing at least 40 hours of training each year for all of its employees. What does this performance target reflect? So when you look at this question, guys, you feel like now when you read the first part, you feel like this is an internal business process. Okay. Because they're saying that they are not efficient, right? But be careful here, right? Now, if you want to improve the internal business process perspective, if you want them to become efficient, then you might have to probably figure out a new way to do something. Like, for example, let's say we were making tables, and what were we doing? We were cutting, and there was like whatever cut pieces that we had, let's say we were keeping it in a place where it was kind of obstructing. Okay, so people had to come and they had to, sift through. They have to make sure that they take the correct piece of wood among the cut pieces and then take it and go for the polishing or whatever. So now you can see there is a problem with the process. Okay, because now, for example, while doing the cutting itself, if we can throw away the waste, if we can throw away the cut pieces and only keep the wood that we have to use, then we won't be wasting time with somebody else coming and sifting through. So you can see there is a problem in the process. So if you want to improve your internal business process, you have to analyze your entire process and see, okay, where can I improve? Okay. But here, what are they doing? They are training. They're training. When it comes to training, the problem is not in the process. The problem is the fact that your people are not good enough. Okay, they are not good enough yet. So what are you trying to do? You're trying to improve their capacity, improve their efficiency, the people's efficiency, not the processes efficiency. Okay, so the moment we're talking about training, we're talking about innovation and learning. Okay, so the answer there should be B, right? Remember this, if it is the internal business process, the problem is in the process. So you have to go and do something to better the process itself. The people are fine. But if you're trying to go and better the people, then we're talking about innovation and learning. Okay, so the answer there will be B. Right. Which of the following could be included in a time series based sales forecast? What can we include in a time series based sales forecast? Okay, so you should remember this. This is time series where we say that your sales, the total sales should equal to the trend, the seasonal variation, the cyclical variation, as well as random fluctuation. Okay. Now, in our paper, we look at trend, we look at seasonal variation. We say cyclical is, the time period may be like 50 years, 100 years. So it's difficult. So we don't look at it for the paper. But in real life, people actually consider cyclical variation also when doing time series based forecast. So 1, 2, 3 definitely in. The fourth one, random fluctuation, guys. We're talking about an earthquake, a flood, a forest fire, something like that. Now, we can't forecast that. Okay, there is no way we can forecast whether there will be a fire, no. Okay, so in our forecast, we can consider trend, we can consider seasonal, we can consider cyclical. Random also affects, but there is no way where we can forecast a random fluctuation happening. Okay, so the fourth one can't be included in the forecast. It will be just 1, 2, and 3. Okay. Which of the following is the best definition of return on capital employed? So that's asking the equation, ROCE. What do you think is the answer? Okay, we have a B. Anybody else? We have quite a few of you, but I don't see you guys reply. Okay, just give me a minute, guys. Sorry about that, guys. Right, so they're asking for the definition of ROCE, right? So we all know that there is an equation, ROCE equals to profit before interest and tax divided by capital employed into 100%. Okay, so all four have profit before interest and tax. Then it's divided, the first one, we're dividing it only by ordinary shareholders' funds. That's not enough. Capital employed means it's equity plus debt. Okay, So ordinary shareholders funds means we're talking only about equity, so that can't be the answer. Second one is saying ordinary shareholders funds plus non-current liabilities. That seems to be correct, right? Into 100. Equity plus debt into 100. That is only capital employed. I'll just read the others as well. Here it is profit after interest. Okay, so these two are completely out. Profit after interest and tax, no. So definitely C and D is out. The answer will be B. Okay, so correct. Okay. Then we have 20.4. It's saying good quality saves money, but the cost of quality can be analyzed into cost of conformance and cost of non-conformance. Now, this is again a very theoretical area. If you don't know this, then you won't be, you will have to just randomly guess. Okay. Which of the following costs are classed as quality related appraisal cost? Okay. So I'll give you a minute. If you know this area, you will know the answer. So you're saying A, which is re-inspection. Okay. Anybody else? Any other answers? C, that is performance testing. Okay. Right. So let me go to that particular slide because everybody has a problem remembering that. That's one area that people can't remember usually. Reason is it's not very important, but you can get questions like this, right? Right. So if I'm not mistaken, we should find that here. Quality. Right. It's not here. It's not here. Just give me a minute. I'll just. Okay, so this is the area, right? Okay. So you can see it says here a quality related. Will this video? Yes, Arundhati, it will be. Okay, it will be, but I don't know if it will be uploaded today itself, but definitely it will be uploaded, right? So it says a quality related cost is the cost of ensuring and assuring quality as well as the loss incurred when quality is not achieved. Okay. So it's like this, right? If you don't have a quality product, then chances are that what will happen with time, your brand will be associated with, low quality products. So with time, what will happen? Your customers are not going to buy from you. Definitely, you're going to see that happening. Okay. So what you can do is, if your customer is going to stop buying from you, that is a big cost that you're going to pay. Now, setting that right is not easy. Okay. So instead of that, what we can do is, beforehand itself, we can probably hire maybe like a quality controller. Okay, maybe make sure that when we're buying the material, there are no damages. We can be proactive. Make sure that the mistake doesn't happen and our final output is actually of good quality. Okay, so now to do that, to make sure that quality is there, we will have to incur certain costs. For example, if you hire a quality controller, you have to pay him a salary. Right? So that's why we're talking about here, quality costs. What we have to pay to make sure that our final product is of good quality. Okay. So the first thing that we have to look at is the prevention cost. That is, make sure that before a problem arises, you have kind of, looked into all the areas that can go wrong and made sure that nothing goes wrong. Okay. So for example, we can do like a routine repair. Okay, or we can train our employees properly. Okay, so prevention, making sure that a mistake doesn't happen. The second one is an appraisal cost. So appraisal means mostly to do with inspection, testing. So for example, look at your raw materials before you send it for production. If you're going to make tables, look at the wood, make sure it is not wet. Okay, make sure that the grain is fine. Make sure the thickness is fine before you send it for production. Because if you see a problem when you are looking at the raw material, you can stop it there itself. You don't have to produce. You can send it back to the supplier and ask for a replacement. Okay, so that's appraisal. Internal failure means basically you have at the appraisal point also you have not found out that there is a problem. So you have sent the raw material into production. The product is also produced, but before we send it to the customer, while it is in the factory or while it is in the showroom, you realize that there is a problem. Okay, you see that, okay, there is a dent. There is a problem with the paint. There's a problem with the varnish. So before it goes to the customer, you have figured it out. So that is an internal failure cost because it's a failure. But at least it was found out at the internal stage before it goes outside the company. Then we have the external failure cost. That is basically you have a bad product, quality is not there. Unfortunately, it has reached the customer. Okay, so the customer is coming and telling you, here, see, I bought this table, there's a big dent. Okay, that is actually the worst thing that can happen to you because at that point, you have to kind of compensate. You have to give some sort of compensation. Plus, no matter what you do, your brand name will take a hit. Okay. Right. So appraisal and prevention, the first two, they are called conformance cost. And internal failure and external failure, it's called non-conformance cost. Okay. So let's look at this now. They're saying, which of the following is classed as a quality-related appraisal cost? Now think about it. What do you think? A quality-related appraisal cost. Okay, now you might think, okay, prevention. Okay, you can see here prevention is there. Sorry, give me a minute. Yeah, appraisal. No. So you might think, okay, inspection and testing, we always consider it to be appraisal. Okay, so you might think, okay, reinspection is appraisal, but be careful, right? A normal inspection, that is appraisal, but this is a reinspection. Okay, so a reinspection means we're talking about we have got a sign, something is wrong. Maybe we already produced the product. Then we are figuring out, okay, no, something seems to be wrong. Let's check again. So at this point, a re-inspection is actually internal failure. Nobody will check again and again unless they know that the first time they checked, something went wrong and it has bypassed that process. Okay. So re-inspection, although the word inspection is there, that is not appraisal. Only inspection is appraisal. Then administration of customer complaints section, that is of course definitely going to go into the external failure cost. Then we have performance testing. Okay, so performance testing means we want to make sure that before this product goes into large scale production, we want to make sure that quality is there. Okay, seems to fit into appraisal a little. Okay, let's look at the last one. Training in quality control. So if we are going to do training in quality control, that means we are trying to prevent a problem. So you can see here training costs goes under prevention. Okay, so under appraisal, the only thing that really fits is this performance testing. So the answer will be C. Okay. So you can see appraisal is inspection and testing. No, inspection in this case was re-inspection, so it can't be that. But yeah, performance testing, yes, it can be included. Okay. Right. 20.5. Which of the following costs would be considered to be the responsibility of the manager of a profit center? Profit center. What do you think is his responsibility? Okay, direct labor. Now, if you think about a profit center, you have to be concerned about cost. Cost also is your responsibility, and any sales also is your responsibility because sales minus the cost only will give you the profit. So definitely direct labor is a cost. He is responsible. Variable production also he is responsible. So we already have an answer. Let's look at C and D. Imputed interest on capital investment invested. A profit center, he doesn't have control over any investment. He can't invest the money anywhere. So any interest to do with investment, obviously is not his responsibility. And any depreciation on machinery, he doesn't have power to buy machinery because again, machinery is an investment. So again, depreciation, he can't be responsible. So the answer will be just A and B. Okay. Right. So then we move on to 20.6, which is to do with variances for the first time. Okay. So let's see if you can figure out 20.6. 1 and 2 correct. One second, I'll just. So I have shared variance summaries with you. I have shared the equations with you. Without the equations, you can't do this question. Okay, definitely you need the equations. This is actually, I told you, right? Variances, you get MTQs as well as MCQs. This is how usually MCQs will be. They will have part of a variance. Okay, it won't be a full question because only 2 marks, no? 3, 9, 1, 2, 5. Wait a minute. What's the answer? They're asking you how many standard hours were allowed per unit ASEA. Okay. Now, when you see this answer, you should remember, you should figure out, okay, if they're going to give you 39,125 hours for 1 unit, imagine how long it will take if it's a normal business. Okay, so definitely you have to work with that number. Okay. Okay. 3.2. That makes more sense. Okay, that makes more sense. So we have a 3.5 and a 3.2. Anybody else? Okay, let me read it. It's saying in a period, 12,250 units were made and there was a favorable labor efficiency variance of 11,250. If 41,000 labor hours were worked and the standard wage rate was 6 per hour, how many standard hours were allowed per unit? Okay. Now we can't think too much. Let's write down the equation. It's always a good thing. We know this is the labor variances. Okay. So we have actuals. We'll have the actual at standard. Okay. And we should have standard. It's always good to start with the equations. So here what will we have? Actual hours into actual rate. Here it's actual hours into standard rate. And here it is standard hours for actual production into the standard rate. Okay. And over here, we will usually have the rate variance, and here we will have the efficiency variance. So this is the format. Okay. Now let's fill in whatever we know. Okay. So they're saying in a period 12,250 units were made and there was a favorable labor efficiency variance of 11,250. So we have the answer for efficiency variance. 11,250 favorable. If 41,000 labor hours were worked, that means actual hours is 41,000. We don't have actual rate, so let's just put whatever we have. And the standard rate, wage rate was 6 per hour. So we have that 6. How many standard hours were allowed per unit? So they're asking you actually for this answer, standard hours answer here. Okay. So let's fill in whatever we know. So 41,000 into 6. Okay, that will give me a total of 246,000. Okay. And we know that the standard rate over here, we don't have the standard hours, but we know that actual production was 12,250 units. And we know that the standard rate was 6. Okay. One more thing is we have this efficiency variance. So we know that the difference between 246 and this answer, whatever it may be, the difference is going to be 11,250. Okay. So this answer, it could be one of two. It can be 246,000 plus 11,250, or it can be 246,000 minus 11,250. Now we have to figure out which one of it is, right? So since it's favorable, that means now this is a cost variance, labor cost, right? Since it's favorable, it means the actual amount that you spent should be lower than the standard. Right? Because the actual we spent, since it's lower only, we have considered this as a favorable variance. So definitely it can't be 234,750, because if that was the case, this will be an adverse variance. Because then we will say we are supposed to spend 234,750, we spent more, 246, spending more is bad. So this is adverse. But in this case, since it is favorable, we should have the answer here as 257,250. Okay, then you can say, we say, okay, according to my budget, I'm supposed to spend 257,250. I have spent less, 246,000. Spending less is good for me. That is why this is favorable. Okay. Now we have to figure out the standard hours. So simple over here. We have standard hours multiplied by 12,250 into 6. The answer is 257,250. Okay. So all you have to do is rearrange this equation. So 12,250 into 6, that will be 73,500. So basically 73,500 SH into 73,500 should equal to 257,250. One second, let me just check it. Okay, so let me just 250 divided by 73,500. Yeah, that should give me the standard hours, right? So SH equals to 250 divided by 73,500. So standard hours is 3.5, right? So you just have to write 3.5 over here. Correct, Husna. Where did you go wrong, Asya, with 3.2? How did that get wrong? Was it when you found out the total? Was that where you went wrong? Okay, so if you guys haven't taken this down, you can take it down and then try 20.7. Okay, so usually we take the total like this. Okay, so if you guys are done taking it, You can try 20.7. Okay, it's another absorption costing story. I think it's marginal costing to absorption costing. That's easy. At this point, you should be able to do it in your sleep. $300,000. Okay, good. What about the others? You can see who is on the line. Okay, 300,000. So can you see? At the first time when you saw this question, this absorption costing to marginal costing, might have felt like, okay, we have to concentrate. But now that this is like the fourth or the fifth question that we're doing, you get the hang of it. Okay, that's what I'm saying. The moment you see that, okay, for 80% of the questions, you're getting the hang of it, you have a flow, sit for the paper there itself. Because if not, what will happen? Even if you delay it by 2 months, you will forget. And then again, getting that is not easy. You know, you will be at your peak, to be very honest, only about 1 month after your lectures are over. If you're going to delay it more than that, then the effort that you have to put to get back is quite high. Okay. Right. So let's do this. It's easy. In the first year of in its first year of operations, the company produced 100,000 units of a product and sold 80,000 units at $9 per unit. It earned a marginal costing profit of 200,000. It calculates that its fixed production overhead per unit is $5. Let's go to the OAR. What profit would it have earned under an absorption costing system? So they're giving me marginal profit and they're asking me to calculate the absorption profit. Okay. So we have this equation, difference equals change in inventory multiplied by the OAR. Okay, so we had a production of 100,000 and a sale of 80,000. So the change in inventory is 100,000 minus 80,000, which is 20,000. Okay, so you can put that here, 20,000. Multiplied by the OAR. So they are telling me it calculates that it's fixed production overhead per unit. Per unit means we are talking about a absorption rate only, right? Because usually fixed production overheads, you can divide it by the number of units also to get OAR. So if they give you fixed production per unit, you can take it as it is. So 20,000 into 5. So that answer will be 100,000. Okay, 100,000. Now we have to figure out, we have the marginal profit. Yeah. So we have the marginal profit. How much was that? 200,000. And we know that absorption has to be either 100,000 more or 100,000 less. So for that, we have to look at whether there was an increase in inventory or whether there was a decrease in inventory. So you can see the production was 100,000 and the sales was 80,000. So production is greater than sales. So if you produce more and sell less, that means your inventory has increased. If inventory increases, absorption gives the higher profit. Okay. So if marginal is 200,000, the absorption costing profit will be 200,000 plus 100,000, which is 300,000. So you have to put the 300,000 there. Okay, good. When you're putting answers, don't put commas or anything. Okay, just put it as it is, right? Right, 20.8. The table below contains details of an airplane's expenditure on aviation fuel. They're talking so much about the airplane and they're saying, finally, which of the following statements is true? So of these four, they're asking you which of them are true. What do you think is the answer? Actually, there's quite a lot of work you'll have to do for just these 2 marks. There will be questions like that also. Okay. B, okay. Anybody else? Okay. Let me read it. Okay. So it's saying the table below contains details of an airline's expenditure on aviation fuel. So they're saying in the year 2018, our total expenditure on fuel was 600 million. 2019, it was 1,440 million. Total distance flown is 4,200 million kilometers in 2018 and 4,620 million kilometers in 2019. Then they're giving you the fuel price index, which is 120 in 2018 and 240 in 2019. Now, the moment you see the price index, you have to understand that whatever calculations we do, we have to bring it in terms of 2018's numbers or 2019's numbers. Okay, we can't just keep it 1 in 18, 1 in 19 and do the calculation. Then it's saying the following statements relate to the changes between 2018 and 19. One is saying the quantity of fuel consumed increased by 140%. And the second one is saying the quantity of fuel consumed increased by 20%. Now think about this. If you want to figure out how much the quantity of fuel that you used, then the best figure that you can use here is the expenditure. How much I spent on the fuel. Okay. Because think about it. Total distance flown, that also affects how much of fuel you use. But think, just rationally think, is it better to use expenditure, how much you spent, which is a dollar figure, or are we going to deal with the kilometers figure? Now, if you're trying to deal with kilometers, there may be so many other things that will come into play, right? For example, how many people were in the plane? What was the luggage? Okay, what was the weight? So many things will affect basically your fuel consumption. Okay, but in terms of expenditure, that is very clear. 1 liter of fuel will cost you this much. Okay, so the quantity of fuel is best decided based on this expenditure on aviation fuel. Okay, so we will figure out how to do the how to figure out how much of fuel we used increased. Then let's read 3 and 4. They're saying the quantity of fuel consumed per kilometer flown increased by 20%. Okay, now careful here. In this question, they have told us how much we spent and what is the distance we flew. They are not talking about the usage. Okay, per kilometer, this many liters of fuel we are using, they are not talking about that. Okay, so the amount of liters that you consume per kilometer, we don't have information to talk about that at all. So 3 and 4 is completely out of the picture. Because if you want to find out the fuel consumed per kilometer, you should know how many liters did you put into the plane, how much was remaining. This you should know we spent this many liters for 1 kilometer flown. We don't have that data. Okay, so the only thing that we can calculate is how much of fuel, the quantity, how much did it increase within these 2 years. So first thing is, let's convert it to 1 year. Okay, so we have 2018 and 19. Let's convert maybe the 2019's 1,440 into 2018's terms. Okay, so how do we do that? We use the fuel price index. Right. So 2019 figures, 1,440. You have to multiply it into the price index of the year that you're converting to. So the year that you're converting to is 120, 2018. And you have to divide it by the price index of the year you're converting from. So in this case, the year that we're converting from is 240, 2019's figure. So this 1,440 into 120 divided by 240, that will give you $720. Okay, so this 2019's $1,440 million in 2018's terms is 720. Okay, so in 2018 we used 600. In 2019, after we make the adjustment, we have used 720. Okay, now all you have to do is you have to find the percentage increase. Okay, you should be familiar with this. You just take the difference, which is 720 minus 600, which is 120. Okay, and this 120, you should divide it by the initial figure, which is again 600 into 100. That's how you get a percentage increase. So 120 over 600 into 100 is 20%. Okay. If you have a problem with how to find out percentage increases or decreases, I used to have this when I was also little, right? So I used to remember this formula. It might help you sometimes, I'll tell you, right? It is usually the final minus initial over initial into 100. I don't know where I found it. I think it's my grade 8 textbook or something. But it has always stuck with me. I never go wrong when I use it, right? So you can see the final figure, 2019 is the later figure, right? So that will be 720 minus initial was 600 divided by the initial, which is again 600 into 100. This will give you the 20%. So if you want to find percentage increases or decreases, this formula will help you. Okay. So the answer is 20%. So answer will be 2 only. The quality of fuel consumed increased by 20%. Okay. Okay, you can take this down if you haven't. So that's where you can see I've taken the 720 minus the 600, which is 120. That's the numerator. And I have divided it by the initial figure 600, which is the denominator. Multiplied it by 100. Okay, so you can take that down. Those of you who have already taken it down, you can have a look at 20.9. Which of the following statements relate to spreadsheets? Which of the following is false? They want to. Okay, we have an A. They are an efficient method of storing text-based files. Okay, seems to be the obvious reason, right? Because now see, this is Excel, it's a spreadsheet. It's good to store numbers, but to store text-based file, you and I know, we will use a word processor. Okay, so A is yes, wrong. Then what is that? Will facilitate what if analysis, sensitivity analysis. Yes, it will facilitate it. They allow data to be displayed graphically. Yes, you can draw graphs, put pictures, put a video, put whatever you want. They allow the font size and color of the text to be changed. It's the best feature that we have in a spreadsheet. Yes, it does allow it. Okay. So yeah, A is wrong. 20.10. What was the favorable sales volume profit variance for November? Another variance analysis. They're asking for the sales volume variance. You can go ahead and try. 30,000 favorable. Okay. 30,000 favorable. Let's see. Okay, so they're asking for the sales volume profit margin variance, right? So let me just always variances, take my word for it. Start with the equations. That only will give you clarity. Okay, actual at standard, and you'll have your standard. Only difference is, if you remember, here in sales variances, this actual at standard column, by default, it's divided into 2. Usually that's not the case, but in this particular situation, usually it's just divided into 2. Okay, better. Right, so here it will be actual. Okay, so here it will be actual quantity into actual price. Here actual quantity into standard price. Here it will be actual quantity into standard profit. And here it will be the budgeted quantity into standard profit. Okay, so they're asking for, now this is the sales price variance. They're not asking that. They're asking for the volume profit variance. Okay, so be careful there. So let me just copy this down. Let me type it. I put the whole thing to give you the picture, but we just need this part. We need only actual quantity into standard profit and budgeted quantity into standard profit. That's all we need. Okay, right. So what is the actual quantity? Let me read the question. It's saying JKB company budgeted to sell 5,000 units of a product in November at a standard price of 30 per unit and to earn a profit of 25,000. It actually sold 6,000 units at 28 per unit and earned a profit of 32,000. What was the favorable sales volume profit variance for November? Okay, so first let's put the quantities. That's very clearly told. No, so actual quantity is 6,000. So I'll put that here. And the budgeted quantity was 5,000 because they budgeted to sell 5,000. Okay, now you have to figure out how to get standard profit. Now remember, standard profit means you should use budgeted data to get that answer. Okay, so we know that we can, according to my budget, I'm supposed to earn a profit of 25,000. That is the budget. And for how many units? For 5,000 units. So I should sell 5,000 units and earn a profit of 25,000. So per unit, the profit that I should have earned, that is going to be 25,000 divided by 5,000. Okay, so 25,000 divided by 5,000 is 5. That is my standard profit. I'll put it here. 6,000 into 5, and here also standard profit 5. Right, so 6,000 into 5 will give you 30,000. And here 5,000 into 5 will give you 25,000. Okay, so now we know that here the total is 30,000. Here it is 25,000. If you want the volume, sales volume profit margin, right? So sale profit margin variance, you have to take the difference between the two. So 30,000 minus 25,000, difference is 5,000. Okay, they're already telling me that it is favorable. Okay, so I don't have to think about that anymore, but let me just see, right? So if you look here, this box is entirely standard. This has a little bit of actual, right? So this is the budget. So according to the budget, I should have earned 25,000. I have earned more. Sales variance, you should always think in terms of how much we should earn. Cost variances, we think in terms of how much we can spend, right? So here I'm supposed to earn 25,000. I earned 30,000. I have earned more. Earning more is a good thing. So this is actually favorable, like what they said. Okay. So yeah, that is your volume profit margin variance. You took the standard price. Okay. Because standard price is what you use to get the sales price variance, right? So be careful there. They didn't ask for the standard price. They asked only for the volume profit. So we need to take the standard profit. Okay. So the answer will be 5,000 favorable, which is A. Okay, so let's look at the last one for the day, okay? Because that's just a theory-based question. We can have a look at it. Saying which of the following are benefits of using activity-based costing, okay? I'll just bring this down. Okay, so in case you want to see. Yeah. Okay, so this is the equation. I showed you the whole sales price variances, and then I just did the second bit because we only needed volume profit margin. Okay. Okay, which are the following are benefits of using activity-based costing? Okay, so activity-based costing, you should remember what it is. Basically, just like absorption costing, but in absorption costing, for all our overheads, we divide it by one base, either the number of units we produced or machine hours or labor hours. But in activity-based costing, what do? We take each of the separate overheads that we incur. So for example, maybe rent separately, a security guard salary separately, and we decide, okay, what is causing this variance? Okay, and depending on the driver, we call the cause a cost driver. Depending on whatever the driver is, we take the overhead cost and divide it by that particular cost driver individually. Okay, so let's just look at what it's saying here. Which of the following are benefits of using activity-based costing? One, it recognizes that overhead costs are not always driven by volume of production. That actually seems to be correct. Okay, because when it comes to absorption costing, we are assuming that all the overhead costs are driven by machine hours or labor hours or the number of units that we produced. In real life, that's not the case. Not everything is to do with the volume of how much we produce, right? Sometimes certain cost, it will be driven by another factor. So in that case, activity-based costing, we find out what exactly is driving the cost and then we do the division. Okay, so one seems to be correct. It does not result in under or over absorption of fixed overheads. That's wrong because whatever it is, end of the day, activity-based costing also is a form of absorption costing. It's just a little complicated form of absorption costing. So like how you can have under over absorption in absorption costing, you can have it in activity-based costing as well. Okay. So 2 is wrong. 3, it avoids all arbitrary cost apportionment. So arbitrary cost apportionment means we are talking about, taking your cost and dividing it by machine hours or labor hours, because usually that's what we do. Okay. But they're saying we don't do that at all in activity-based costing, which is again wrong. If a particular cost was really driven by labor hours, then we will divide it by labor hours. We don't have a problem with that. If it was really driven by machine hours, we will use machine hours. Only if we feel, okay, a particular cost is driven by something else other than labor hours or machine hours, that's when we will go and divide it by other things. Doesn't mean we completely forget about labor hours and machine hours. Okay, so 3 also is wrong. It is particularly useful in a single product business. Not really. Single product business means you only have one product. Okay, so if you have a big fixed overhead, you can just divide it by the number of units you produce, and that will be a good enough overhead absorption rate. Okay, the problem itself occurs only when you have more than one product, when you have 2 or 3 products, because then you have a problem. Okay, how much of the overhead can I give for product A? How much can I give for B? If you only have one product, then no problem. No, you can just take the entire fixed overhead divided by the number of units you produce. Right? So ABC doesn't make sense if you only have one single product. You can use the normal absorption costing. Okay. So there the answer actually is 1A. It recognizes that overhead costs are not always driven by the volume of production. Okay. Answer is 1 only. Right, guys. After that, we have another IRR I can see. We will do that next week, right? So I'll see you again at 6 o'clock on the 16th. Today's the 9th, no, yeah, on the 16th of May, right? So take some this week also to better yourself. Hopefully, as we progress through the TRGs, you should also feel that you're getting more and more confidence. Okay? Right, that's it for the day. Have a good week ahead. I will see you next week. Yes, Asya, at PPIM itself, you can book your dates and you can come and sit for it whenever you want. Okay, no problem, Shahla. Okay, so I think you have to give them a heads up, like you can't I tell like tomorrow if you want to sit for the exam, you can't say it today. I think you have to give them some time. But yeah, it's at PPIM. Okay, right.